Hello everyone, welcome to week 4 learning videos and this video is a discussion on learning objective 5. There are two possible approaches to asset allocation, strategic asset allocation and tactical asset allocation. In this learning objective, we discuss tactical asset allocation and examine evidence relating to the performance of tactical asset allocation. So tactical asset allocation involves timing the market in order to shift the asset allocation across asset classes. For example, this would be making predictions about the future performances of the economy and financial markets. If an investor thought that things were quite prosperous in the future, that would dynamically allocate a large proportion of their wealth towards higher risk asset classes such as equities. Whereas if there was a forecast that the economy and financial markets were going to perform poorly across the future, then that will dynamically allocate away from risky assets and invest into very low risk or risk-free asset classes. Now, when engaging in tactical asset allocation, there are a range of different signals that funds tend to use. These signals include market sentiment, market valuation, and moving average measures. Market sentiment is an intangible concept, but it's the idea that you can pick up the future movement of the market if you can gauge the general feeling of the populace and investors within a market. There are a range of different ways that investors seek to gauge market sentiment. This could include measures from financial markets. For example, there is a belief that when IPOs are more prominent, a greater number of shares listing on a stock market that reflects a positive sentiment within the market and hence that market periods of prosperity. Equally, recent studies and recent funds have tried to engage market sentiment using the vast amounts of data that's available across the internet using like Google search stories of investors and postings on social media. Again, there is a range of arguments that people suggest that a measure of overall sentiment can be derived, and this can be potentially used to predict future market movements. Market valuation measures used in tactical asset allocation include the aggregate P ratio and the term slope. Aggregate P ratio is the average price earning ratio across a market. When this is low, it reflects current market prices are low as a multiple of expected future earnings. That might be a time that is considered to be a good period to invest because the stocks are cheap and it might be expected that risky assets are going to increase in value in the future. The term slope is the difference in interest rates on long-term versus short-term securities. This is used in tactical asset allocation due to the belief that if you have a downward slope yield curve whereby long-term interest rates are actually lower compared to the short-term interest rates, then that is believed to be an indicator that economies may be about to perform poorly or may be about to enter into a recession. So tactical asset allocation funds would see a downward sloping yield curve as a signal that they need to invest in defensive asset classes. A third group of measures are moving averages. Moving averages is where you look at current price or the current market index value compared with the average over a past period of time. So when the current price index moves above the average, let's say the last 200 days, then an investor would say that's a signal that the market is trending upwards compared to its recent past, and investors should buy at that time. Whereas when the price moves below its moving average, that's arguably a signal to sell. So there are many ways people are lured to this idea of tactical asset allocation, and they are particularly lured because we have a spoken idea about the idea that more than 90% of the variation in portfolio performance is actually explained by the asset allocation decision. So, if markets are less than perfectly efficient and investors are able to predict future movements, there is huge scope to potentially outperform the market. But there are some detriments of tactical asset allocation. First of all, switching at the wrong time. We know that when you dynamically switch, you actually can sometimes miss the best time of the market. Take the global financial crisis, for example. If an investor had predicted the global financial crisis and switched out of the market just prior to the GFC, But let's imagine that the investor had not switched back into equities until mid to late 2009. In that case, the investor would have actually missed a large proportion of the rebounds that occurred in the early 2009. Hence, while they would have benefited from predicting the GFC, that benefit would be significantly moderated by the fact that they didn't participate in the subsequent rebound. The second factor is the transaction cost. Asset allocation investors are trading far more frequently, and when you are trading more frequently, this imposes higher transaction costs. Additionally, it will also result in a higher tax liability. This is because investors will be selling their assets more frequently, and in a market like Australia where you can get a concessional discount on capital gain tax if you hold an asset for more than 12 months. So if you are an asset allocation investor, you are trading frequently, you are not holding assets for more than 12 months, so you are paying the full capital gain tax liability and high tax rates. So the question is, given that there are significantly increased cost and risk associated with tactical asset allocation, is this a strategy worth pursuing? Well, the way that we can examine that is by looking at the performance of tactical asset allocating funds, and the evidence suggests that tactical asset allocating funds actually do not outperform the market. This is likely due to extremely increased transaction costs and the fact that markets are relatively efficient, so it is quite difficult to predict future market movements with a high degree of accuracy. To borrow a quote from Warren Buffett, the only value of a stock forecasters is to make fortune tellers look good. So Buffett himself here is arguing that markets are relatively efficient, and investment strategies that are based on making predictions about the future, which is exactly what tactical asset allocation is all about, doesn't appear to have a whole lot of merit. Thank you.